All right, I think we're live, baby. Ladies and gentlemen, boys and girls, we have another beautiful show for you today, and guess who I have as my guest speaker? You guessed it. You've seen the thumbnail, Laser Eyes old Papa Powell. That boy is going to come out. I'm going to give him the microphone, and hopefully he says some good things about the overall market, because we don't want to see this market head any lower. We are bearing down past the 10-day moving average currently at 543.24, and we could head down a little lower. We know the 21-day moving average is just below it, but let me hit you with that intro, baby. All right, guys, so we have the Fed chair speaks. He speaks in 30 minutes. I got that up for you. We have the live stream rocking and ready. Usman, what's going on? What's your expectations for the market? As a history shows, BTC, Bitcoin, always makes bottom in June as we near our new bottom. Or are we near our new bottom? Good morning. Dan, Bob, Dan, the greatest moderator alive, is here. Usman, good morning. B. Stewie, good morning. Everyone, good morning, B. Stewie. It's good to see you guys. We got plenty more piling in here very soon. I got some coffee sitting here ready to sip, but it is hot heat. Let's go ahead and take a look at Bitcoin. We got about 30 minutes before it comes up. So, you know, when we talk about the history of Bitcoin or any asset whatsoever, I don't ever go on, you know, what history is done, because usually gold doesn't go up when the market goes up. You know, usually there's many different things that don't correlate in the overall market. So I always just use technical analysis and catalysts. And right now, instead of looking at the history, I like to look at this technical chart and I say, well, hey, look, we've broken the new all-time highs, which is showing there's still buyers, okay, that are willing to push this up higher and past its all-time high. It's not selling off as we get up there, and it's creating new higher lows here. All right, I did expect this thing to push through here or here, and it did not. It pulled back down and it bounced. So we just got to see what it does. If it continues to create a base off this top and we get a big push up through this $7,200 area, $72,000 area, I think Bitcoin has plenty of room to head higher. What's up, Bonnie? What's going on? It's good to see you. Let's see what else we got. So the S&P 500, guys, my main watch is to see what happens here with this S&P 500. So right now we're currently trading at 543.42. Maybe we'll move this down here so that way we can see a little better. And what my main thing, guys, if you guys don't know me very well, is holding this 21-day moving average. All right, so we push up, we push up, and we pull back, and we start riding this 10-day moving average. It's looking really good, and then we pushed and made a new all-time high 2 days ago. So okay, so on actually that was Friday, I believe. Push up, reached a new all-time high, pulled right back down, and then yesterday we did the same. We pushed up higher, we pulled right back down. Now in pre-market, we're trading a little lower than this, but it's a-okay, except for one fact. Old Papa Powell is coming out today in less than 27 minutes, guys. Less than 30 minutes, he's gonna come out, and what he says usually moves the market. And why does he have so much influence on the market? Well, because everybody's expecting a Fed rate cut. And if we look at the overall Fed rate watch tool, which is this beautiful little watch tool right here, guys, you will see that the Fed is most likely not going to cut rates in July, okay? But we have high hopes in September. Now, September, we are showing that we have a 63% possibility of coming down a quarter of a rate point. Okay, why are these rate cuts so important? Well, because if we get a rate cut, this market has shown that when the Fed starts cutting rates, it heads higher. So I do expect the market to continue to head higher. Of course, it does a great job pricing it in, and this is most likely why we started to push up so soon, is because everybody's expecting the Fed to cut those rates and for it to head higher. It's time to drown out any morning yawns with a sip of coffee. This one's for me, not for you. Actually, you know what? This one's for Eric NG. Good morning. Can I share my opinion on the USD the GPY? Actually, I cannot. I don't do Forex. That's not something I do, but we can take a look at the chart and see what the chart shows. Yep, I only trade equities here. But anyway, back to the Fed rate cut in September. I'm seeing a 63% chance to come down of a quarter of a rate point. I absolutely love that. I do love that. Now, a lot of people are asking, are we only going to get one or are we going to get two rate cuts? The question really remains is, what is the overall data going to come out? Because we are data driven. The fact that we are data driven, we've been data driven for so long, when we look at November, you can see we actually are going to, well, at least what it's showing at 51.4%. A quarter of a rate point is probably where we're going to stay. So we're going to cut in September, probably stay in November, but in December, you can see here, it looks like we are down to a half a point. Meaning if we cut in September or if we cut in November, but my guess is September, if we come into November, by that time, we should be down a half a point. At least we are more likely to be down a half a point than we are to be down a quarter of a point. So that's why all eyes are on old Papa Powell. So when he comes out, we have the meeting up and ready. We do expect him to say some pretty cool stuff. Let's see if we could pull up. I don't usually pull up Forex, but we can give it a try. The Japanese. Yeah, I don't have, there it is. Here it is. All right, check it out. So if we look at this on a technical basis, let's just bring this out here. This is just for you, Eric. This is my first time really looking at a Forex chart. I don't really care. We can see the overall RS ratings at 72. And if we look at this, we're on a constant uptrend. We broke new all-time highs for the USD Japanese yen, and it is continuing higher. So this is a nice run to the north side. Now, if I were to play this like I were to play any other chart, I would have to wait for a basing or a trend breakout. So this is a trend breakout. This is a trend breakout that's following moving averages, okay? But I don't play Forex. This isn't something I do. I do find it interesting to see how they all correlate. So it's pretty cool that you're in here and you're checking this out. What do you think, Eric? Let me know in the chat what you think is going to happen with the USD JPY. I know the last time I looked at one of these, it was the Canadian dollar, because the Canadian dollar, after they cut, their Fed actually cut, I think it was last week or 2 weeks ago, they did a Fed rate cut, and everybody was expecting their dollar to climb higher, if I'm saying that right. All right, but in the meantime, this is the S&P 500, and guys, if you want this charting platform, you can get it absolutely free. Every resource we give you is going to be absolutely free. I would like you to use my affiliate link, of course, and let me just go ahead and post that for you in the chat. All right, there's the affiliate link just for you, and if you want to use that, you can get yourself $15 off if you plan on getting a better or a higher subscription. I use the Essential plan myself just because I like to use a few more indicators with my moving averages. We also have a video in our YouTube to show you how I set this up. Covey actually does it for you, one of the gentlemen that is a huge part of our community. So go ahead and check that out. This here is the S&P 500. Now you can see, if we take a look, take a little peeky gander, if you will, at the S&P 500, you can see we have created new higher lows. Well, technically this is the low and these are the new higher lows, but we are still holding these higher lows. So things are looking really good for the S&P 500, and I would like to see continuation on this trend. And after we have broke this 10-day moving average, our next stop is most likely this 21-day moving average. If we can get a quick flush down to this 21-day moving average, I would love to see it bounce off that 21-day moving average and then start to rip higher. That would be the probably most picture perfect thing, since if we look back here, guys, you can see a nice bounce off this 21-day moving average as it held for so very long. As we broke down here, we called that out. We said, hey, look, we need to be hands off here. And then it had this 6-day bloody sell-off, and then it started to hold. It made a hold at the psychological $500 area, and then it bounced off. We were back being risk on. This whole time we've been risk on here, guys. This was the only day, it was just overnight, where we risk off. And so we are going to continue to be risk on until we break the 21-day moving average. Sure, we can come down, but once we break that 21-day moving average, we will be hands off. We will wait to see what the market wants to do. If it wants to come back down to the 50-day moving average and bounce, then hey, we will be there to see it. So Powell comes out in about 20 minutes, guys. Do you have any tickers that you want me to take a look at? If not, I have a few tickers that I'm in currently. We have Kava. I'm in Kava. I took this yesterday. I'm waiting for a break of the previous day's lows. So I can just go ahead and mark that right now. We're up a whole $17 on this trade. Obviously, it's not much whatsoever, but I'm giving this time to work. This is a nice trade in my opinion, but if the market doesn't want to hold out, it's not going to be that nice of a trade, is it? So we're just going to put a stop order at the base of previous day, because where I took this, if we measure the average daily range on this is 5%. My stop loss is at 3.3%, which gives this a full day when I got into this for it to come down and either stop me out or continue higher. So if this thing wants to continue lower and wants to stop me out, it will do that today. If not, and it shows that it is strong and where I bought it is going to be a nice push higher, then we are going to get that today and Kava will continue higher. Now, these aren't buy or sell recommendations. I am playing this base breakout / trend breakout. Here's your trend. Here's the breakout on volume. Here's the volume down here. We also have this base right here at this top that we have played as well. So that's what we like to see. Kevin Kilgore, he says VST. Let's take a look at VST while we're here. So VST is getting tight. It's following that 50-day moving average. I'm going to set my alert just above that. The only thing I don't care for this, Kevin, is that the 10-day is breaking through that 21-day moving average. But I don't really care as much. It's just something I take a note of. If this wants to continue to hold this 50-day moving average or even show a couple more tight days, I like this trend right here, this trend down. So if it wants to break out above this, my alert will set off for this VST energy. We also, if we look at our, if we look at our stock heat map, you can see that energy was doing pretty well. Energy minerals was doing well, pretty much neutral as the overall market came down yesterday. And today it's neutral as well. As Apple and Microsoft and Nvidia, Amazon, JP Morgan, all of our bigger boats, Tesla, they're all leading the stock market today. So we need to keep in mind that that is what's going on, because when old Papa Powell comes out, you're going to see this heat map change pretty quick. You're going to see him come out and he's gonna shake things up. That's for sure. Kevin Kilgore, Night Owl, my man. What's going on, man? Good morning. Glad to see you in here, brother. Yeah, Kava's my only take. I do have quite a few that I'm keeping an eye on my watch list. We have CORZ. You can see this has a nice, now we went over all this last night in our Discord. You can join our Discord, it's absolutely free. Check the description down below. We have meetings every Monday through Thursday where we go over the market every single day, guys. And we also do some studying while we're in there. None of us are like the gamblers. We're all very meticulous. We all have a process. We all like to trade our certain ways, but our main focus is the trend and the base breakout. So it's really nice. What's up, Muley? Awesome art. It's good to see you in here. Good morning, good morning. So we have CORZ on our watch list. We have CLS on our watch list. You'll see a lot of these look very similar. You can see this one here. We have a downtrend here. We have FLYE. This is what I call a shit ticker, but it is having a very nice area right here. We like to see that. ENVX, Jimmy Bright. Good morning, brother. I'm glad you're in here. Dan Bob, the greatest moderator alive, posted our Discord in our chat right there. Thank you very much, Dan Bob, Dan. We have ENVX. One other thing I like about ENVX that my boy Danny pointed out to me is ENVX has this I like to watch this on the 30-minute. You can see if you pull off the high, this is the anchored VWAP here. And if you pull this off the high, this anchored VWAP is showing that it is resistant. So if ENVX cannot just get above this 1565 area, but break above on volume above the anchored VWAP from its high, I think that's going to be a nice tell-all for this thing. Oh, that's my war cry as a yawn. The older you get, the more your war cries aren't war cries. They're more like cries for the bed, for sleep. No, only kidding, guys. My coffee's kicking in. It'll be good to go. And old POWELL comes out in 15 minutes, guys. I have it up. It's sitting right here. It's hidden. It's ready. It's good to go. It's good to go, baby. It's good to go. This sip is for me, not for you. This sip's for me. Let me know now in the chat. What are you guys drinking? You guys sipping on that coffee? All right, now check it out. We got a vote. We got a vote up here. I got the vote up here. But first, because we got a speech, I want to make sure everybody is live. So right here, if you look on my screen, make sure you click this live button, because we only got 15 minutes, make sure you stay live on this chat. So click that live button, and while you're here, smash this like button. And if you haven't already, smash that subscribe button, guys. It only takes a quick second. It helps out this channel a lot. We're up to 951 subscribers. Of course, you know our goal is to hit 1,000. That's a huge goal of mine. We've been working at it for about 3 or 4 months now, so it's a very fast-moving community, and we got 15 votes on this poll. The poll asks, will the SPY, the S&P 500, hold up during the Powell speech? Because for a while there, anytime he would turn on that microphone, it would just drop. Recently, we are starting to see a bit of a change. We're starting to see some volatility, but it's not necessarily always to the downside. Now, 73% of you say it's going to go higher during the speech, which is overwhelmingly different than what it used to be. 13% of you say we will go lower during the speech, and 13% of you also said that you are too sophisticated to vote. Well, I appreciate you sophisticated ones that are out there still helping the channel out. So we have, let's see, 13 minutes until Powell comes out on the stage. We are going to get a very, very nice speech from him. Now, what are we expecting from this speech? Well, I can tell you this, guys. When old Powell comes out, he sticks to his criteria. That criteria is what? Keeping American jobs, number one, right? And reducing the inflationary rate to 2%. He's going to come out and he is going to talk about any of the issues that we might be having, and all eyes are on Powell. All eyes are on him. Why? Because we are the greatest nation alive. We have submitted this Fed policy. Everybody's watching how we do things, and a lot of people follow how we react to the overall data. Okay, a lot of these places will follow what America does. So Fed Chair Powell is a very important board member. A lot of people like to hang on his every word, just like we like to come out to see, is he hawkish? Is he dovish? Is what he's saying still stands true from what he has said before? It's very important to watch this man and to take notes. I will always be taking notes, in which, speaking of which, I want to make sure this is all ready to go, because what we do is we take the notes and then we review afterwards, so that way if there's any questions on anything, and of course, if I can't answer those questions, I make sure I find a way to bring that information for future shows. We are always here to better ourselves, because remember, guys, you are a loser unless you're learning. That's what we like to do. If you're not learning, then you're losing, guys, and we don't like to lose. No way, no how. So while we only got 11 more minutes left before that Fed Chair Powell speech starts, we want to keep in mind we have Kava. Kava's on the watch list. This was the breakout yesterday. We have COHR. This is what I'm expecting on a trend break here, COHR. A beautiful trend break here on volume would be absolutely scrumdiddlyumptious. And we have AGIO, which is also forming another beautiful trend. If you don't see the trend, I'll just draw it out for you. Very simple, holding a 21-day moving average. You'll see, guys, all the trades that I take are very, very similar. MDGL, you can see another beautiful trend line forming, holding a 10-day moving average. And SMLR, another beautiful trend line holding very nicely here. All right. If you guys have any questions on what's on my watch list, you're more than welcome to ask. RNA, we also have this on our watch list too. So the Fed Chair Powell speech comes out and we're going to be listening to it. You might see me changing a lot of this of what's going on in behind your screen because I'll be doing some live trading back here because the market will be open and I will be live trading while we're here. So don't mind me if I'm doing a bunch of stuff in the background. I do want to make sure that you guys understand that the S&P 500 won't always be up. You might actually see me trading one of these trades that I have in my watch list in the background here. So no fret, no worries. But old Papa Powell, he's got about 10 more minutes. 10 more minutes. Now I'm expecting him to come out a little dovish here. We are kind of lingering on this 10-day moving average. And if we look, let me restore these cells. If we look, we're sitting at 543.52. So that is just below that 10-day moving average. We're kind of looking like a big drip here where we're going to come down and we're going to retest a new moving average. Now, I would love to see a retest of this area right here that we held multiple times, which is 540. So that 540 area is the area that I'm expecting it to hold. If it doesn't, well, I'm going to be hands off in the overall market. If we start to bounce off of 540 in the S&P 500, you better believe I will be grabbing some of these shares as long as my alerts go off in the what we have just spoke about. So do keep that in mind, guys. I'm pretty pumped about this. We like to see pullbacks. When you're a momentum trader, you want to see the momentum last for a nice long time. And then after our setups start to relinquish, we start to see less of these setups, then what we want to see is the market to pull back so that way we can see more setups, okay? It's healthy for the market to get a pullback, and of course we are always rooting for the market to continue higher. Because if you have a 401k or a Roth IRA or grandparents who are retired, they are banking literally on the market to continue higher. If not, they will lose a lot of money very quickly and they will have to be very, very frugal. That means you do not get no presents for Christmas. You want presents for Christmas, right? I know I do. I know their grandchildren want to be gifted some presents, right? So keep that in mind. We're always rooting for the overall market to continue higher because we want to pad our pocketbooks. We want to make money, all right? So let me just do a little watch see to make sure we are up to date and we got everything going down as it is supposed to. All right, looks like everything's going well. We're also going to keep an eye on the CME Fed Watch tool while this speech is going on. I'm going to constantly refresh this to see if July changes. Now, I don't think we're going to get a big change for July. I think it's very clear that we're going to stay. We're going to have a Fed rate stay. But I think September is going to change. If we start to see this number go up, you better believe the overall market is going to go up with it. I think you're going to see the change in the market before you'll actually see the change in the Fed Watch tool, but it's nice to keep an eye on that. And especially in November, since we have a 26% chance to be down a half a rate point. If this starts to really go up, then we know we are more likely to get 2 rate cuts in this year rather than the one that has been forecasted for so long. So yeah, guys, make sure you are caught up on the live stream because we're going to be starting in 7 minutes. The Fed Chair Powell speech starts in 7 minutes, guys. So make sure that you click that live button, click that like and subscribe button, guys. Jolene. Good morning, Jolene. It's good to see you. You know what, Jolene? This one's for me. This isn't for you, but cheers. Cheers anyway. I got the Christmas cup today. You like that? Actually, it's weird because I have more Christmas cups for coffee cups in my cabinet than I do any other cups. But Jolene, all right, this one's for you, Jolene. Okay, this one's for you. Cheers, Jolene. Jolene has been an advocate follower. Advocate follower? Is that the right word? I know, I'm still waking up, guys. I'm still sipping on that coffee. Give me a minute. But she's been a very good follower lately. And I tell you, I really appreciate everyone's help. I appreciate everyone's dedication because this channel is growing so wildly fast. I see we just got another subscriber, so thank you to whoever subscribed. Appreciate you. We are growing very fast. Our goal of 1,000 subscribers is coming very, very soon. And we have less than 6 minutes, guys, till old Papa Powell. I'm going to let him speak. I'm going to let him be my guest on my show. Like, hey, who would have thought old Papa Powell would show up on our show? But hey, you know, crazier things will happen very, very soon. And we'll be taking notes, guys, so make sure after what's my expectations about the market? Usman, that's a good question. So the S&P 500, as long as we hold above a 21-day moving average and we bounce off this 540 area, I'm still going to be risk on. Right now, I'm still just kind of sitting back and relaxing. As long as we can hold this 10-day moving average, I'm good to go. I'm going to hold my Kava. It's the only trade I have. If we start to see breakouts in some of the recent stocks that we just talked about, like CORZ, CLS, FLYE, ENVS, Kava Core, COHR, MDGL, any of these that have these trend breakout strategies, because I play a trend and a base breakout strategies. We are momentum traders here, so if the S&P 500 wants to hold out, wants to continue higher, I will play that momentum to the north side. If Papa Powell comes out and he's very hawkish and he's saying that we will only be getting one rate cut, or he does not seem that he wants to mandate any rate cuts, you're going to see the market flood down to the sell side, probably blowing through the 21-day moving average. So I have an overall biasy or an expectancy for the market to continue higher. But of course, if Papa Powell comes out in less than 5 minutes and he starts chitty-chattering about less rate cuts or seems overly hawkish by any means, then you are going to see this market start to come down very, very quick. Okay, guys? So we only got a few more minutes until this is going to start. We'll see if they start on time. I know I was here on time. I know that much. Let me take another sip of coffee. I want to be awake and alert for this. And if you guys want to stay after, we're going to be doing a review. So make sure, Covey, thanks for the shout out, brother. Covey just messaged me. And cheers to you, Covey. I appreciate you and everything that you do for this show, brother. But if you guys want to stay after the show, after he makes his speech, I'm going to take some notes and I will go over the changes, because a lot of his speeches are usually the same. He talks about the inflation and how he's going to bring it down to 2% and how that is his main goal, and keeping jobs, and then he usually gets the same questions about immigration and how that's affecting things, and he explains why it's either good or bad. You know, he'll come out and he'll say all of these different things, right? What I'm looking for is the key nuances that are different. Something that he says that either moves the market, that people are taking a watch at, that hasn't been priced in the market yet. All right, if it hasn't been priced in, we want to ingest that data. We want to have a better understanding of what all Papa Powell has to say. Now, not only is Powell coming out in 3 minutes, but the overall market is going to be opening up here in less than 3 minutes too, guys. So you're not going to just see the S&P 500 up here. I'm going to be doing some live trading. If the market starts coming up and the market starts ripping, I'm going to need to stay very focused on what the overall market's doing, because you might see some live trading going on here, okay? And don't mind me, there's going to be a lot going on. Of course, I will keep up on the chat. You guys come first. I see we got 28 people in here. So just before the start of the speech happens, do me a huge favor. Make sure you hit this live button right here. Look at my screen really quick, guys, before we start. Very quickly, hit this live button. Make sure that you are live so you can see exactly what's going on when it happens. Smash that like button, guys, and then hit that subscribe button if you haven't already. It's the last time I'm going to ask you until after the speech, so make sure you do that. Thank you guys so much for joining. I love to see how many people are in here. Trader Rex says he needs your coffee, David. Trader Rex better keep his paws off my coffee. Usman says, can we see any new market except stocks, Forex, and crypto? As we can see any new market except stocks, Forex, crypto? No, I'm not exactly sure what you're asking. Do we show crypto? We definitely follow Bitcoin on here. We definitely follow Bitcoin, and I definitely have on my trader view, we can look up any cryptocurrency on here, and I'm more than happy to look at the stock chart. I don't trade crypto on here, but we do look at the charts of crypto simply because the charts, the technical analysis, they are all the same. It shows human emotion right here, okay? That's human emotion right here. As somebody's buying, somebody's selling, it's human emotion, so we will look at those charts as well. And as we speak, we got less than a minute left before not only is the market open, but old Papa Powell should be coming out and speaking for us. So pay attention, folks. I know we got quite a few of you in here, so thank you so much for joining me. We have less than 1 minute till the market opens, and old Papa Powell is supposed to come out and have the gift of gab. The question on the vote was, will the SPY, the S&P 500, hold up during the Powell speech? 74% of you said we will go higher during the speech, which is an overwhelming high amount of votes that think the market is going to continue higher. I like the positivity here. It always pays to be positive. 16% say that we are going to go lower during the speech, and 11% of you say that you are too sophisticated to be voting on a poll. But I totally understand that. And now the market is open. So let's go ahead and pause this. We'll get rid of this. And we are waiting for old Papa Powell now to come out. So we will be here live for when he does. We're going to keep a very, very close eye on things. We have FLYE and RNA already popping off. We're going to see what happens with these. It's unfortunate because RNA, I know that they're diluted, so it makes it very, very hard for me to want to trade these stocks. Where are you, Papa Powell? Come on out, Papa Powell. We are live, just so you guys know. We are just waiting for it to start. It should start very, very soon. If you're finding it any faster or anywhere else, let me know because we want to know. Fed Reserve Board calendar. Yeah. I'm just going to make sure because it's supposed to be up right now. So we'll see. We'll see if it's anywhere else. Nope, hasn't started yet. Hasn't started just yet, guys. So just be patient. Be patient. We do have it up. I just want to make sure that it's coming out when it is supposed to come out. Let's see, what else alerts do we have going on? I need to link up my phone. Okay, here we go. Here we go, guys. Fed Chair Powell, this is
inflation in the euro area has fallen substantially from its peak.
If you have any questions, I'll be in the live.
And we at the ECB are absolutely determined to ensure that inflation returns to our target. But like other central banks, we also find ourselves in an era of transformation. Geopolitical shocks, a changing climate are driving this change, upending our old reality and replacing it with new uncertainties. As central bankers, our role will remain the same as before, ensuring price stability. But the world in which we operate is likely to become far more complex. So at the ECB Forum, in the beginning of July, we will discuss how central banks, including us, the ECB, can best navigate this new terrain. Please join us.
Inflation is now returning to central banks' targets. Many have already cut interest rates. Others are considering doing so. The questions now are how low will rates go and whether the global economy can weather the political risks that we see all around us and avoid a serious recession. Our next panelists are very much better placed than most to provide the answers. This session will be moderated by Sarah Eisen, an anchor at CNBC. Sarah, the floor is yours.
Thank you. Thank you very much. I'm so honored to be back on this stage. We were here a year ago, and it is my also great pleasure to welcome three people who need no introduction in this room. Chair Powell from the Federal Reserve, President Lagarde, our host from the European Central Bank, and President Campos Neto from Brazil. This time last year, when we were all talking, you guys were in the sort of final process of hiking rates. Fast forward 1 year, and now it's interesting. While I'm going to miss Governor Ueda and his jokes, we've got three great panelists here going at different speeds, I would say, when it comes to reversing that course. So would love to just open it up, President Lagarde, with you and ask, where are you in this process? Because you cut in June, so now what?
Well, it's been a journey. You can't just say, "Oh, we cut in June." It's coming on the back of a period of hikes, which was unprecedented, facing shocks that I tried to describe yesterday over dinner, and followed by a period during which we held rates untouched, and during which we were restrictive enough to actually see our medium-term target reach that 2%, which is our objective. And most recently, we have seen in our round of projections, which are really important, September, December, March, and June, we've seen that 2% target with an oscillation of 0.1 about it at the last quarter of 2025. So it's on that basis and on the basis of what I'm happy to describe as the three-leg reaction function and all the underlying data and information that feeds those three legs that we decided to do a 25 basis points cuts. But in the same breath of air, I also said that it was not a linear process, that it was not a predetermined path that we were embarking upon, but a step that would be followed by further review of data, further understanding of where our three legs reaction function would be. So that's pretty much where we are. And I would simply maybe add that we are very advanced in that disinflationary path, and we are in that sort of slow recovery which came about during the first quarter and which we hope will persevere, but all of that is flawed with uncertainties and big question mark about the future.
Sounds like you're setting up the market for a pause now. Is that right?
I'm not setting up anything for anyone. I think that it's for everyone to really look under the skin of the economy and see where it's heading, and appreciating what our reaction function is and how we're likely to decide.
Chair Powell, you have also been on a journey and have been on hold since last July, have not cut rates like the ECB in June. Why not? What are you waiting for?
So let me say that sitting here last year, there was a lot we didn't know, and we didn't know that we were just about to embark on a period of 7 months of much lower inflation readings. We didn't realize that the second half of last year was going to be an extraordinary year from a growth standpoint, and also from the standpoint of the labor market. So things actually worked out in the second half of last year in a remarkable way. Then, as you know, in the first quarter of this year, we continue to have solid growth in the first half, actually, solid growth, and a labor market that's still strong, although we've seen a continued rebalancing in the labor market. And inflation, after pausing in the first quarter, now shows signs of resuming its disinflationary trend. So it's a little bit different journey. So where that leaves us is we've made quite a bit of progress in bringing inflation back down toward target, while the labor market has remained strong and growth has continued. We want that process to continue. I think the last reading and the one before it in inflation, the one before it to a lesser extent, do suggest that we are getting back on a disinflationary path. We want to be more confident that inflation is moving sustainably down toward 2% before we start the process of reducing how tight our policy is, of loosening policy. That's what we've said, and what we'd like to see is more data like what we've been seeing recently. We'd also like to see the labor market remain strong. We've said that if we saw the labor market unexpectedly weakening, that is also something that could call for a reaction.
How much more confident do you want to be? The PCE number 2.6, that wasn't too bad that we got last week.
That's right. So we're actually on a 12-month basis. We're actually at 2.6, both headline and core for inflation, and that represents really significant progress. I think we peaked at 5.4% in core, and the same thing has happened in headline. We've gone from 7.1 to 2.6. So yes, we've made a lot of progress. We just want to understand that the levels that we're seeing are a true reading on what is actually happening with underlying inflation. And as we were saying at the last part of last year, people were saying, you need to declare victory, this is over. And then we had a quarter of inflation which was well above 3%. So we want to be more confident, and frankly, because the U.S. economy is strong and the labor market is strong, we have the ability to take our time and get this right, and that's what we're planning to do.
So
Market
September?
reached 545.08. 545.08.
I'm not going to be landing on any specific dates here today. Let me also say that we're well aware that if we go too soon, that we could undo the good work we've done of bringing down inflation, and if we go too late, we could unnecessarily undermine the recession, the recovery, and the expansion. And so we're aware that we have two-sided risks now, more so than we did a year ago. That's a big change. I'd say risks are coming much more into balance now.
President Campos, you have been on a different journey because you've actually been cutting rates for much of the last year and have recently paused. Why? What are you seeing in inflation data, and what are you going to do next?
Okay, so if you go back a little bit in the history of time, so Brazil was one of the first countries to hike rates. I think in part because we had a different call on the dynamics of inflation, both locally and globally, and I think that turned out to be correct. And then at some point in time, we started the easing cycle, and throughout this process of easing, we've seen that inflation has converged. We have some of the problems that are common to advanced economies and other Latin American countries, which is labor markets very strong. So there were 2 points of attention. One was labor market being that strong, would that at some point in time mean inflation in the service side? And even though we haven't seen that yet, what we try to do is to try to estimate what would be the components of labor in every service so that we can anticipate if that were to happen. We haven't seen it, but we think it's, there is somewhat of a correlation when you look at the margin. And so most recently we decided to pause. That had to do not only with the current numbers and with this suspicion that we had service inflation that could peak at some point in time, and also because food prices were going back up a little bit, and I also think that's not only happening in Brazil, it's going to happen in some other places too. But also has to do with a lot of noises that we had. So we decided to interrupt the cycle. More recently, we've had a sell-off in some of the emerging market countries. Brazil was more affected. But I think this has to do much more with noises that were created than the fundamentals. And the noises are related to 2 channels. One is the expectation on the path of fiscal policy, and the other one is expectation on the future of monetary policy. So when you had these 2 at the same time, I think it created uncertainty enough that for us, we needed to interrupt and see how we can fix that channel and how we can communicate better so that we can eliminate those noises. Because there is a big disconnection with the current data, both fiscal and inflation data, and the expectation. So what happened in Brazil is the expectations started to the anchor, even though the current data is coming as expected.
Right. So you're talking about the fall in the stock market and the real recently when you talk about the markets.
But for us, what matters is how this gets into our reaction function. So I'm talking about expected inflation, the long end of interest rate curve. So we had somewhat of a steepening of the interest rate curve. We had a devaluation of the currency. But for us, what matters is the expected inflation, both implied inflation from the markets and expected inflation from the surveys. Those have gone up.
Yeah, I mean, President Lagarde, you have described the path to 2% as bumpy. We got an inflation report in the Eurozone this morning, 2.5%, not too bad, but core was high and services are still above 4%. So what is keeping prices so sticky?
Well, first of all, we had, as you said, a number that was lower than last month. So we said it was bumpy, and it's heading in the right direction for the indicator that we use, which is HICP, to measure inflation and to set our target. So that's good, but we still believe that it's likely to be a bumpy road until the end of 2024. But we still have target at the end, in the second half of 2025, on the basis of our projections, and the baseline is unequivocal.
Currently trading at 545.17.
You are correct that services hasn't budged. So services is at 4.1, if I remember from the numbers that we got this morning. And obviously we are very attentive to the components and what is behind services. And the real issue is to understand whether those are, this is caused by sort of permanent changes, or whether it is also a factor of the lag effects of other components which are finding their way more slowly and gradually into services. And the jury is out as to exactly what it is. The truth of the matter is that we do have a service number that has gone slightly up in the recent months, and which is now staying at this 4.1 percentage points. Now, obviously, we don't need to have services at 2% because manufacturing goods are below 2%, the weight of those within the index. But we have to look really what is behind it. And what's behind it is a lot of wages. Services has a very high component of labor. Wages also suffer from the lag impact of the labor system that we have in Europe, where clearly bargaining agreements are negotiated not only on an annual basis in some countries, but sometimes on a triennial basis in other countries. So you have this catch-up effect. You know, for those people whose renegotiation took place early this year, they had not had a negotiation of wages in the last 3 years. In the meantime, of course, inflation went up and their real wages went down. So there is an element of catch-up. So we need to really unpack all that to get to the root causes of inflation behind services. So we'll continue to look at that. We need data. It applies to wages. It applies to profits, because we are seeing profit gradually declining compared to the height where they weren't at the end of 22. But we need to see those profits absorbing the wage cost increases to make sure that the second round effect is out of the window and services are also going to be on a declining path as well. But services is the difficult one.
I was just going to pose that Taylor Swift is touring Europe this summer. Oh my God. And there tends to be an inflationary effect in services. Am I right, Chair Powell? We saw it last year, didn't we?
It's not just Taylor Swift, you know, others have come as well. Larry Spring.
I don't know. I saw her at Wembley and there was a lot of spending going on. No, but how do you look at the services, the stickiness of the services inflation, and how tied it is to wages, which have been rising?
You know, famously, services inflation is stickier, and famously it's tied to wages. I would say, so look at the U.S. labor market. We've seen a pretty substantial move toward better balance than we had a couple of years ago when labor was in, you know, extreme shortage. So what you see now is an unemployment rate that's moving back up toward a more sustainable level. You see wage increases moving back down toward a sustainable level of wage increases, inflation, and productivity. And you see, you know, vacancies to unemployment ratio coming back to where it was pre-pandemic, and so many other measures I could mention. So that's what we're seeing. And so the labor market, wage increases are still a bit above where they would wind up in equilibrium, but nonetheless, you can see the labor market is you know, cooling off, appropriately so, and we're watching it very carefully. Yeah. But it doesn't look like it's heating up or presenting a big problem for inflation going forward. Indeed, it looks like it's doing just what you would want it to do, which is to cool off over time, not quickly, not suddenly, not steeply. It's kind of what we've been hoping to see and have been seeing. So, and you know, services generally they're such a mixed bag, particularly non-housing services are a mixed bag. Some of what you're seeing is catch-up inflation from inflationary pressures that happened earlier. You know, that's true with insurance. It's also true with housing services inflation, where you've got some pent-up rent increases that have to work their way off. It turns out it takes more than 1 year for that to happen. It takes several years. So we see all that in train, and you know, we don't see ourselves getting back to 2% inflation this year or next year, or maybe late next year, but in the year after. The main thing is we're making real progress.
Can you keep cutting President Lagarde if he keeps holding? Does it make it harder?
Well, look, you know, I'm going to give you the conventional response because that's the conventional question you ask me. We do take into account the spillover impact of whatever is decided by other esteemed colleagues. And obviously, my esteemed friend, Chair Powell is one of those. So we take that into account, but we also determine, our monetary policy on the basis of what we see in our economy, and we look at the data that we get, the impact that multiple factors have on our economies and its numbers.
Does it matter for you, President Campos, what the Fed does next?
Well, I think it matters to an extent, but I think there is one point that is worth mentioning, which is more recently we've seen a sell-off in some of the EM, and especially the EM that had more, there were like more the best cases for investment. And you see that this is being explained with local news. But when you have a lot of sell-offs in different markets and they're all explained by local news, you have to ask yourself if there is a more fundamental factor driving that. And I think there might be. It's difficult to make the case right now, but definitely what we see now is there is more risk premium in a lot of the emerging market countries. And it was very synchronized with the long end of the US curve, and that correlation broke. So we've seen the last couple of weeks that even though the 10-year yield is more or less stable, even actually going a little bit lower, we saw a bit of a sell-off in emerging market countries. And I think that has to do with the fact that as you go for longer with higher rates and much higher debt, you start extracting liquidity from the market, and eventually you are repricing that liquidity. It could just be a temporary adjustment in EM, or it could be the beginning of a more profound movement. We need to wait and see. But I think the correlation between the US Treasury and some of the EM has been broken in the last couple of weeks. And I think we should pay attention to that.
What about the fundamentals in emerging markets? Because the economies seem to do better during this hiking cycle than they have previously. Why do you think that is, and does it continue?
I think most EMs did a better job in terms of, or at least an equal job in terms of anticipating the process and starting the hiking process. Also in the fiscal part, on average, emerging market countries spent more or less 10% of GDP facing the pandemic. Advanced economies spend a little bit more than 20. So I think there is also this thing which didn't happen in the past, which is by and large, emerging markets were able to deal with the pandemic spending less. And actually, when you look at the fiscal post-pandemic, emerging market continues, it's not the case of every country, but continues to do a little bit better. So I think that also change the dynamics. And one of the things is, I think, the independence of the central bank and the maturity that a lot of the central banks have gained in emerging market proved to be very useful during this process of the pandemic.
I mean, all of your economies did better than expected with the interest rate hikes, wouldn't you say, Chair Powell?
Yes, I think particularly, I mean, many forecasters had a recession in 2023, which not only turned out to be wrong in the case of the US, we had well in excess of 3% growth. So.
But you still see policy as restrictive?
Yes, we do.
How restrictive?
Well, so that's kind of an empirical question. So I guess I would say, if you look at, we do think policy is restrictive, and we think that's appropriate. I think if you look at the labor market in particular, you're seeing demand for labor gradually come down in the form of job openings, and now a slight softening in unemployment in the form of wages. You see demand coming down, not just the supply that we're getting, but also demand coming down. You also see the effects of high interest rates in the housing market and in some other interest rate sensitive things. So you see that, and I think, I do think that restrictive policy is working hand in hand with this broad supply side recovery we've had, where we've seen the unwinding of the shortages and bottlenecks from the pandemic. We've also seen a recovery in labor force participation among prime age individuals in the US, and then some immigration, which has also been a positive supply shock. So we've seen all those things work together to give us, really significant declines in inflation. At the same time, we've got a strong labor market and growth. This was it's a great outcome for the people that we serve, and it's one that we want to do everything we can to foster.
So why not just cut rates to protect it?
It's what I said earlier.
Is it a bigger risk? Sorry, I'll rephrase. Is it a bigger risk that you cut prematurely and inflation stays sticky, or that you wait too long and the economy loses more momentum?
that is the question. And so, and our answer to the our answer to the question is we serve a dual mandate, right? And these two things are embodied in that mandate. The risk on the inflation side is that you move too quickly, inflation comes back, and we didn't really solve the problem. And then we have to go back in, and that would be very disruptive to the economy. So the other risk is that we wait too long. We understand that, and the labor market softens too much. Perhaps we lose the expansion. So needless to say, we don't want to do that either. So, but at the same time, so we've got to balance those two. And again, given the strength we see in the U.S. economy, we can approach that question carefully. But as I said earlier, though, you see. A year or so ago, we were talking about inflation, and our framework called for us to focus on the variable, the mandate that is further from its goal. That's not, they've come back much closer into balance. And a good way to see it is the beverage curve analysis that everybody talks about and looks at. We've come straight down the beverage curve, which you're really getting to that place relative to job openings and hiring rates, where traditionally the beverage curve is flattened out, which would mean higher unemployment as a result of further declines in job openings. So you can't know that with precision, but it's very much understood by us that we have two-sided risks and we have to manage them.
What about the recovery in the Eurozone, President Lagarde? It's also been pretty resilient, especially on the unemployment front. How confident do you feel in sticking this soft landing?
Well, we reached a level of confidence back in June when we decided to actually cut rates by 25 basis points. But as I said in the opening remarks, it's not something that is taken for granted, that is a given, and we're going to re-examine each and every step of the way whether that confidence is actually continuously reinforced in order to continue on that path. And the remarks by Chair Powell made me really reinforce my points about data. Because we are navigating in this universe of one risk versus the other, but where data is so important. And data is so important because we proceed always with the burden of the lag of time, whether it's the impact of our policy decisions, whether it's the impact of wages, whether it's the sort of on-time data or not. All of that has to be taken into account and analyzed in details so that we can feel really confident that we can go forward.
At the same time, there are also political risks. Certainly they're front and center. It was nice of all the authorities to make elections all happen this week, certainly in France and in England. President Lagarde, is there anything the ECB can do to shield the rest of the Eurozone from feeling any negative impact from a divided government in France or from whatever the result is of the French election in a negative way?
I thank you so much for your question.
It can't be a surprise.
Because I'm not going to comment on the political situation of any of the member states, particularly those that are facing elections at the moment. But obviously, the European Central Bank has to do what it has to do. Our mandate is price stability. Price stability is obviously relying on financial stability, and we are attentive to that because this is part of our job, and we will continue to do so.
Does the rise in French bond yields look worrisome at all?
These are the things that we monitor. This is part of the job. It's not particularly at this point in time. We do that all the time, and we are very attentive.
You have fought hard for the central bank's independence in Brazil, and yet now you are the subject of many attacks from President Lula, and so I'm wondering how you're dealing with that.
Attacks from me?
No. No, President Campos. Attacks from President Lula. I think he called you an adversary and an enemy.
Yes, well, I think as a central bank, we have to get away from the political arena and try to go on with the technical job. And I think what we did, is a living proof that everything that was done was very technical. So during the elections in which Lula was elected, the incumbent president, in his last year of mandate, we increased rates in a cycle that went from 2% to 13.75%. That's the biggest increase in rates in an election year in the history of any emerging markets. So if that is not a proof that you are independent and you acted autonomously, it's difficult to find another example like that. So I think all this narrative that the central bank has been political, I think we have to get away from that and explain what we're doing. And I think what we're doing has been very technical. The last decision was unanimous, and we now have 4 members in the board that were chosen by the current president. And I think what we need to separate it was what is the political narrative and what is the technical job that we need to do. And I think history will tell and time will tell that the job was done in the best we could do with the data that we had at hand, and that was in the most technical way, and it was done in a group of people that actually analyzed all the data and that worked very judiciously to be able to get to the conclusions that we did.
Chair Powell, do you have any advice for him? You've been through some attacks from
I have no advice. I will say, though, to put it in my words, you know, we've been given this great responsibility and great powers, and really important that we get it right. And we've been told to stay out of politics and just do your job, and that's what we do. When we don't try to get involved in issues that are not our issues, and in particular, we're just focused on our goals and getting through that. And if we do that and do it well, I will say in the United States, there's very broad support for an independent Fed in both political parties on both sides of Capitol Hill and everywhere. I don't think that that's really in question, as long as we just are seen to be doing our job and staying on task at all times.
Can I say something?
Yes, please.
I think that there are countries where governors do exactly what Chair Powell said, and yet get blamed, criticized, and I think that for some it takes courage to do the job, in addition to being a good, excellent technical expert.
But I do wonder if you're concerned, because your term ends, President Campos, at the end of the year, and it doesn't seem like President Lula is going to reappoint you. So do you worry about the independence of the central bank?
Damn.
So first, I was never up for reappointment, regardless of who won the elections, and I've said that from the very beginning. When I helped design the independence law, I actually tried not to have the reappointment possibility in the law. And for me, the reason was I didn't want that the president of the central bank, at any circumstance, would have any incentives to bend his knee in order to have any kind of re-election. So that we need to make that very clear. Secondly, there is actually a risk premium down in the curve, and I think it has been elevated in the last couple of weeks as to an uncertainty of what happens when the next leadership or the next team takes place. But this in Brazil is done very slowly, because the president can change 2 directors every year, and we have 8 directors plus the president. So right now we have 4 directors that were appointed by the current government. And the last monetary decision, was unanimous. So I think what we did in the last decisions proved that the group is very cohesive in trying to find a technical solution for the country. So I understand there is a risk premium and there is always this uncertainty, but I think the group that we have, which is composed of 8 directors plus a governor, voted unanimously, understanding that that was the best for the country at that time. And so I understand that there is a risk premium, but I think with time that risk premium will tend to decrease.
There are concerns in the United States about Fed independence if President Trump gets elected. There have been reports that he's looking at that issue. Obviously, you've been subject of attacks before. What is your level of concern about that?
I am not focused on that at all, and that's not just a talking point. I really think that we just keep doing our jobs. I mean, the U.S. economy, we have 4% unemployment. It's growing at 2%. Inflation's at 2.6%. Let's keep that going. Let's do our jobs. History will judge. I think if we can keep things on that path, that's what I'm focused on. That's the only thing I'm focused on. And as I mentioned, I do think support for the Fed's independence is very high where it really matters on Capitol Hill in both political parties, among the leaders and most of the following. And so I worry about getting the job right. That's what I worry about.
I know you guys don't want to touch politics, but President Lagarde, it does bring into focus the fiscal policies, right? We heard President Campos say it. There are concerns about the deficits in France, if the far right should win. There are concerns in the United States about the deficits. So I do wonder if you have something to say or to warn on the fiscal front as it relates to making your inflation fight harder.
Well, fiscal matters enormously, true, and it matters in two different ways from my perspective. It matters from a sort of conjunctural type of way, and thank goodness the European authorities have agreed on the fiscal governance that will take over after the Growth and Stability Pact has been has been suspended and now completely replaced. So there is a framework within which members of the European Union have to operate, have to control the direction of their debt, have to make sure that it is sustainable going forward through the efforts that they deploy, and have to keep their deficit on watch with enough flexibility, and that's the second part of fiscal spending that I'm concerned about, with sufficient of an impact of a focus on productivity, on growth, of investment that will be conducive to both. And my hope is that in addition to operating within the European fiscal framework, which has been agreed by all European members, in addition to that, countries will actually look at the structural changes that they have to either continue to have in their arsenal of tools, but also that they will continue to improve going forward, because I regard that as critically important for productivity purposes, which we are lagging behind and have been lagging behind for a long time. So we're not so worried about fiscal expectations, as Roberto was saying, for Brazil or emerging market economies, but we're very concerned about the fiscal rules that have to be respected within the European Union, and the structural reforms that will be conducive, hopefully, to productivity improvement going forward, because that's the only way for Europe to actually remain strong and thrive in those changing circumstances and transformations that we have talked about.
And I know you're allergic to fiscal policy, Chair Powell, but I have heard you talk about the unsustainable debt burden of the United States. And even lately, there's been a sell-off in treasuries after increasing odds that President Trump will be reelected, that there might be a sweep of either party. Doesn't that make you nervous when it comes to the progress you've had on inflation? If we do see more expansionary fiscal policy, more deficit, bigger deficits, bigger debt loads?
So I'm going to give you the traditional answer to some extent, and that is that we just know fiscal policy is a job for elected people. We're not elected people, so we don't comment on it, and particularly in advance of a presidential election, we're not commenting on anyone's particular policies one way or the other. I will say more broadly, though, the United States is running a very large deficit at a time when we're at full employment, and it just is, the level of debt that we have is not unsustainable. The path that we're on is unsustainable. That's completely non-controversial. I would have thought that this is something that should be a top-level issue, and you do hear this from a lot of elected officials, but it should be a real focus going forward, is how do we get back to a sustainable path, because you can't run these kinds of deficits in really in good economic times for very long. I mean, I wouldn't say, I can't really speak to the time, but in the longer run, we'll have to do something sooner or later, and sooner will be better than later.
President Campos?
Yeah, let's do a basic exercise. If you look at the total debt combined, just sovereign debt of US plus Europe plus Japan, that's 64% of the total global debt. That went, in terms of cost of servicing that debt, it went from 1.1, 1.2% before the pandemic to around 3.3% right now. But then you added 25% of GDP to that debt, which was the cost of facing the pandemic. So we have a much higher debt, and a much, much higher cost of
Do me a
servicing.
favor, guys. Hit that like and
Serves the
subscribe
debt.
button while you're here.
So I think
We're
there
trying
is
to
an
grow this community.
aspect
We're very
globally,
close to hitting that 1,000 subscriber marker.
that is the extraction of liquidity that cumulative will have an effect in the market that sometimes is not pricing correctly. And if you think about what we have to do right now, we have to pay for the cost
S&P 500
of the
trading
transfer
at
programs that we did. We need to pay
right now,
for the cost of the green
545.40.
transition, which is
Still
somewhat
holding above
expensive.
a 10-day
We need
moving
to
average.
pay for the cost of the fragmentation, which you look at the surveys and it's very costly for companies and for governments. We need to pay for the cost of the low-income countries that spent very little during the pandemic and now need support. We need to pay for the cost of demographics. And there is a surge in consumption of energy that needs to be paid because of the innovation. So we have a lot of bills to pay. A lot of bills to pay. We are at the highest level of debt that we had in a long time. And I think it's sometimes I stop and I think it's time for us globally to think about a way to get to some kind of stable trajectory of the debt in the next couple of years. And it's not one country or the other. It's something that we need to do collectively because the global debt is very high and is going to start taking a lot of liquidity from the markets. And the ones that will feel the effect are not the advanced economies, are the emerging economies, emerging market economies. And the low-income countries are feeling that effect already.
And you think the market is mispricing this risk?
I think the market was mispricing a little bit the fact that if you have higher rates for longer, the effect from extracting liquidity, depending on how much longer you're going to have these higher rates, I think the risk is higher than what the market is pricing as.
I also wanted to ask you, President Campos, about China, because you have a pretty good view. It's such a big trading partner for you. What's going on there? How much is China's economy slowing?
I'm not sure I'm very equipped to tell you what's happening in China. I can tell you that that is very important for a lot of emerging market economies. It's very important for Brazil. We are a very big exporter of food items and iron ore. So China is a very big trade partner with Brazil. And it has been for a while. And regardless of the government, it's important to understand that that is a very important tie to Brazil. The one thing that we look from looking from far away is we're trying to see what are the policies that China is doing, what is the focus, and what is the impact that this new policy will have for us. But because we export mainly food items and iron ore, we don't see that as a big threat. I think some other countries will have a different understanding of what this impact will be.
Yeah, I mean, there's also trade barriers that are going up. President Lagarde, tariffs. I mean, in our election, we're talking about potentially more tariffs. Are you seeing that in terms of growth and inflationary impact?
Well, we're not seeing yet more tariffs than what had been decided back, 8 years ago, and which was consistently maintained later on in relation to certain products. So that for the moment is stable. What is not stable at all is the number of protective measures. Occasionally, non-compliance with WTO rules, the level of disputes that are brought before the WTO, which is not in a position to resolve them because they are not equipped with the dispute resolution mechanism, and magistrates have not been appointed to that effect. We've had more than 3,000 trade protective measures decided in the last 2 years. And that is like 5 times what is the normal average of measures that are decided. So that's a concern. And it's a concern because trade has been fueling growth, and because Europe at large is not a small open economy, it's a large open economy. And trade restrictions are going to affect Europe much more so than other countries that operate without this degree of opening and vulnerability in a way. But the second reason I'm concerned about it is that typically trade is conducive to innovation. Innovation is necessary for productivity. And I think that the combination of reduced trade on growth and the impact of trade on the capacity to innovate and to improve productivity is a vulnerability for Europe, and one that we have to address very forcefully if we want to win this battle of productivity. So and it's not independent from inflation. I'm not getting away from my topic, but it's one that is clearly a concern on the horizon.
But, and it could be inflationary. I mean, 10% across the board tariffs, Chair Powell, inflationary?
Of course, I'm not going to be scoring any potential political proposals which have been talked about. It's just not our job to do that. Also, almost anything affects the economy. Trade affects the economy, immigration, energy policy. Those are not our jobs. There are other agencies that do those jobs. We do maximum employment, price stability. So in our political economy, we stay out of that.
Right. But has implications for price stability, surely, and maximum employment.
Again, we're not looking to be, this is exactly what we're not looking to do, which is to become players on issues like tariffs. I mean, because it affects, I mean, literally everything. All these things affect inflation and jobs. But notwithstanding that, there are others in the elected government who are responsible for trade policy. We don't comment, that's all.
Understood. So back to your job then. There is this debate and among the Fed and other central bankers about where policy rates are going, R-starred, the neutral rate, what that rate should look like, and whether it's different after COVID. What do you think?
Can we go back to trade?
Yeah,
No.
sure. Please.
So, R-star. I guess I would start by saying that the thing that we write down as part of our summary of economic projections, and the thing that economists mean by R-stars, is a longer run concept. It's the rate of interest that would hold the economy at equilibrium at a time when we're at stable prices and maximum employment and there are no shocks hitting the economy. So this is not the economy today. So the first thing to say is that when we're sitting in the boardroom in Washington thinking about whether our policy rate is the appropriate rate for this economy right now, we're not battling over what long-run R-star is, because this is a different economy. This is an economy that's still recovering from the pandemic. And so many forces are pushing it this way and that way, and there's really not a lot of precedent, so it's a very challenging time. But it's not, the question, the R-star question is a really interesting question, and that is, are we going to go back to the very low levels of neutral rates that we had in the recovery of the global financial crisis, or are we going to go part of the way back from today's high rates to that? And you know, intuitively, most people think that we won't go back to those very, very low rates that we saw, you know, during the global financial crisis recovery period. But we don't really know. I mean, the neutral rate has moved around, we think, by slow-moving, longer-run forces, demographics, technology, productivity over time, all of those things move it around. Ultimately, the balance between savings and investment. So it's a great conversation to have. But honestly, when we're looking at policy in the boardroom, it's how is our policy affecting today's economy, and do we think we're getting the results that we want? And you know, by and large, in a world where this isn't a world of precision, we think we are. We're getting a gradually cooling economy, a gradually cooling labor market, progress on inflation, 4% unemployment, 2% growth. We're getting kind of what we would want to have. And so that's, I worry that some people, no one in this room, but some people think that the R-star debate is the thing that dictates our assessment of how restrictive policy is. It's really not. Unless you think that the long run rate is the same as today's rate.
I think that investors are trying to figure out, though, where you're going to end up and what the policy path looks like once you start cutting rates. And it becomes important then.
No, I agree. It does. Yeah. It's what will we discover to be? We'll find it empirically. What will we discover it to be? And I think there's a debate going on. There are people who feel very strongly that it hasn't changed and that it has changed, and ultimately it's unknowable. It does matter for the longer run. It matters for where rates will settle out, but it doesn't matter much for policy decisions today, which are the ones we're actually making.
I guess we want to know if there are like 10 cuts coming or 15 cuts. I mean, do you think, President Campos, it's changed post-COVID? Are you dealing with a different economy?
So the R-star story for emerging market countries is a little bit different. So for example, if you had a table of countries of Latin America, you would find that at least the models internally used by their own central banks, in some cases you had R-star going higher, like Brazil, from 3 to 4.5. But in some cases you actually had R-star going lower. So the question is, what is the short-term view and what is the long-term view, as Chairman Jay described? And I think for us, it's more like trying to understand what is the structural reason for the neutral rate in Brazil to be so high, 4.5% real time, is really high. And I think a lot of it has a lot of structural elements from the past, but it has intensified during the pandemic. And you could go and talk about the amount of subsidized credit. You can talk about the trajectory of the debt. You can talk about productivity. For example, when you look at productivity, there is one thing that not a lot of people talk about, which is in the need for raising money, sometimes the adjustment is done on the revenue side. When you do the adjustment on the revenue side, if you look at what's being done in emerging market countries and even in some advanced economies, you tend to go back and tax capital more than labor, because it's very hard to tax labor coming out of a pandemic. If you tax more capital than labor, and this has already been happening for a while now globally, and especially in emerging market, then you introduce another element that will bring productivity lower. So when you look at the causes of the neutral rate to be so high structurally, that's, I think, what we need to work on. And Brazil has done a lot of reforms. Now, we have done reforms, and I think if you compare to other EM countries, Brazil was actually able to do reforms in the middle of the pandemic. We did the social security reform, we are doing a tax reform, we did the labor reform, all in the middle of the pandemic. But still, when you look at the efficiency of what was done, the end result seems to be that our structural rate is still our neutral rate, our star is still too high. And I think we need to go on and talk about what are the reforms that are needed in the medium term to make sure that we have a structural rate, a neutral rate that is lower than we have right now.
President Lagarde, do you ever see a world where we get back to near zero interest rates absent a crisis?
Do I think we're heading towards that? That's, in my view at this point in time, it's very unlikely, but it's not something that I would want to pass judgment on. What I can tell you is that when we start having that conversation that Chair Powell described perfectly well and that I would completely subscribe to, I would be relieved, because it would mean that we are getting closer to where we need to be. It would mean that we do not have any shock suffered by the economy, nor on the immediate horizon. So that would be good news. But we are certainly not at this stage, and this is not the work that we do when we set our policies going forward.
One thing that's been moving fast and has the potential to impact economies is generative AI. And I know we started talking about it a little bit here on stage last year. It was early. But things have moved, President Lagarde. So how are you thinking about any impact on growth or productivity or inflation of what's happening in technology?
Why, Sarah, that's a subject for which we need another hour, because there's so many questions about it. Number one, there has to be some regulatory framework within which AI and generative AI in particular, especially if it's in the hands of a small oligopoly of companies, is actually organized in order to protect a number of rights and protection of citizens. I would start from that, which is not where we are for the moment, although there are attempts to organize in a better way, as was the case with internet, on a global basis, the use of generative AI. So point number one. Point number two, and I will let Roberto talk to that point because he's more of an expert than I am, the question of how much energy is used in order to test large language models is really something that is not often in discussion, and yet it matters enormously. Third, the impact that AI will have on growth, on inflation, on productivity, I think is yet to be determined. I think most people would agree that it will have an impact throughout the ladder of jobs in most segments of the economy, in areas where mechanical developments have not historically affected jobs in particular. And it will require significant amount of training and constant upskilling of people so that they can adjust to artificial intelligence, use it, and not be victims of it. I would add to that I think we at the ECB are using artificial intelligence, try to do it in a safe environment without being hostage to those companies that would like to have access to the most private of our data. So it does require a cautious management and enough control without preventing the innovation and the creativity that people can apply in the use of these tools.
You use it in models? How do you use it?
We use it in models. We use it in, whenever we need a lot of language mining, and whether it's structured or unstructured data, for that matter, we use it, and we are constantly pushing the frontiers of that. But as I said, cautiously, because we need to protect data, and we need to make sure that there is enough human judgment involved in the process of this use of artificial intelligence, so that we are not either hostage to the mechanics itself.
Do you think that fears over generative AI, Chair Powell, rendering certain jobs or industries absolute are legit? And is there anything a central bank can do?
I don't think we know. So you see this massive investment boom. You see, serious people in the private sector and the public sector. There's a sense of something big coming here. And it feels like what that will be is it will eliminate some jobs, it will create some new jobs. And the question really is for many people who will it augment their labor and make them more productive, or will it eliminate their job? And I just don't think we know that. It's too early to say. There's not a lot a central bank can do about that. This is really a job for. We can supervise our financial institutions and things like that to make sure that that they understand what they're doing with all different kinds of technology. But also, like everybody else, we're meeting with all the experts and asking ourselves what will be the effects on productivity, on inflation, on growth, and will it be enormously displacing, and if so, of whom? One thought is that it'll be more people doing white-collar jobs who are writing press releases and things like that. So we just don't know. It's something we're investing a lot of time and effort. We're not using generative AI. We're very carefully looking at that. Other earlier forms of AI are in fairly common use in American business, and I believe we use some of that.
What about you, President Campos? I know you're focused on the energy needs as well.
Well, first, I think when you look at the surveys that we have, and we have plenty now on the use of AI on companies, what you have in terms of empirical evidence up to date is that the companies that use AI to enhance existing labor have had better results than companies that have replaced labor for AI. So that's something that we know. It doesn't mean that some jobs won't be replaced by others, as it was said. But I think what we need to understand is what we are seeing basically is an increase in the ability of processing data and storing data. So it's basically computer power and the ability to store data. And that's very energy consuming. You have a couple of dimensions that you need to look in. You look to privacy, where is the limit, and what is the taxonomy of using this once it becomes a global instrument? What is the taxonomy of using this? Because you could be talking about data centers being placed in countries that have cheap energy to produce services for countries that have more expensive energy. So once you start crossing the frontiers, thinking about how you're going to do this movement globally, I think there's a lot of consequences. And one of which I think is you're going to have very unequal growth between the countries that are more on the edge of producing this technology and the countries that are not, and the energy consumption also be very unequal. So I think globally we need to look at how we're going to connect the dots and create more or less a taxonomy for this development to be sustainable.
In the minutes that we have left, I want to do sort of a quick lightning round of questions. Mainly, we talked about opportunities, we talked about economies. What about the biggest risk facing your economies? And I do wonder if they're the same or different. Chair Powell, what's the biggest risk facing the U.S. economy right now?
Yeah, I mean, I traditionally have said cyber risk to that because we know how to deal with credit risk. We know how to deal with lots of kinds of risk, market dysfunction, things like that. But we haven't really had a big successful cyber attack on a financial market utility or a bank. And that's the kind of thing which I think is, the stuff of lying awake at night. I would also, today though, honestly, really it is just the balance that we talked about, getting the balance on monetary policy right during this critical period. That's really what I think about in the wee hours.
President Lagarde?
Same thing.
Really? Really? Cyber risk?
I think, I'm saying that touching wood, actually, and I wish, yeah. Because it's one, if you ask the financial sector, if you ask banks with which we interact a lot, sometimes much to their chagrin, but eventually to their satisfaction in the long run, I'm sure, because we supervise them carefully. But typically, that's a risk that they flag as one of their top priority risk, and on which I think we need to constantly improve the level of coordination, first, second, third line of defense, and best way to respond to those. Now, clearly, I'm concerned as a person more than as president of the ECB about the backlash that there is against the fight against climate change. And some would argue that it has nothing to do with central banking, but I would contend that this is actually not the case. It does have a ramification impact that we should be mindful about, but it's a risk that is there and that will come to haunt us if we don't do much about it.
I thought you were going to say geopolitical risk. That's there too, right? Facing Europe?
Geopolitical risks as defined by Maurizio earlier on? No, who was it?
Yeah, Moritz.
We heard a lot about geopolitical risk.
It's there, and it's just on the doorstep of Europe. When you look at this horrible war against Ukraine, it's a major risk which is out there and which is hurting those on the ground and the neighboring countries in particular.
What's your biggest risk?
If you look at what markets price today, they will probably, at least for part of Yemen, especially for Brazil, the conclusion would clearly be that the main risk is fiscal. But I think that comes and goes, and it has to do with growth and productivity and a lot of the things. I think there is one other risk that I see, and it's not very tangible, which is the polarization that we live today. If we think about the amount of time that we spent on some social issues that are connected to polarization and that are not that meaningful to produce well-being of the society, I worry a lot about that.
Yeah. So if we're sitting here on stage in 1 year from now, which we hopefully are, the inflation rate in the US will be?
Mid to low twos.
That's we're mid twos now.
Yeah, well, we have 1 month at 2.6. And, we had a brief visit to the low twos at the end of, but I mean, sustainably, durably underlying inflation between 2 and 2.5 is what I would say. That would be a great outcome.
Headline PCE.
Yeah.
President Lagarde, 1 year from now?
1 year from now, I would say low twos. We are at 2.5 latest reading, and as I said, bumpy on the way ahead, but yeah, low twos.
You've been closer to 4%, President Campos, right, lately? So where do you think you are in a year from now?
Well, I won't be in the central bank a year from now.
We already established that, yeah.
But I think that the work that's being done is very technical. I'm confident that we'll continue to be that way. And I think when you look at expected inflation today, I think it has a disconnect with the current inflation, and it has a disconnect with the fundamentals that we have in Brazil. So I'm confident that the future inflation will be lower than the expected inflation. In other words, I think what the market's pricing today is not in sync with the reality.
What about the unemployment rate? We're going to go full dot plot here.
Yeah. I'd be happy if it were just right where it is now. That would be a good outcome. Plus or minus a couple of tenths would be good.
Is that likely?
Yeah, I think it's reasonable.
It's starting to rise. It's
moved up from 3.4. We touched 3.4, so we're up to 4, but 4 is still a very low level. It's been a long time since, the last time we were at 4 or below for this long is, I was a teenager, a long time ago.
Also, unemployment rate in Europe, it's been, what, healthy, 6.5%?
Historical low,
yeah.
And I hope it stays there a year from now.
What's the unemployment rate in Brazil?
Well, it's close to 7% now, which is very low when you look at our history. I think probably we'll go up a little bit, but not too much. But I think what we need to look at is the participation rate. So we just published a study that shows that the transfer programs have an impact in the participation rate. Our participation rate was down and then it's recovering a little bit at the margin. And I think it would be very important to understand what is the dynamics of the participation rate going further.
The S&P
And finally,
500
Chair
is
Powell,
trading at
were you
545.54 currently,
a
close to
two-cut
today's
dot
all-time
or a
highs.
one-cut dot for 2024?
No comment.
Thank you
Big round of
very
applause.
much, all of you,
Thank
for
you.
participating. I tried.
So thank you there for such a wide-ranging and fast-paced discussion.
All right, I think we're gonna cut them off there so I can get to my chitty chatting. But I don't know. What did you guys think? What did you guys think about the? I know Walter Sheen has his clear thoughts that are all posted in this here. But what did you guys think? I mean, I feel like he went over what he always usually does. We're on a clear path. We're trying to keep employment rate high. We are trying to keep sustainable growth, as well as bringing that inflation down to that 2%, and that we're getting very, very close to doing that. Just to mark on the S&P 500, I was actually surprised. I personally thought that we were going to head lower. I always say it pays to be positive, and I always like to be positive. So I'm always hoping for the best, of course. But on our poll, if you guys want to take a little peeky gander at our poll here, we had 33 votes, which is very awesome. The question was, will the SPY, or the S&P 500, hold up during the Powell speech? And 67% of you said we will go higher during the speech, which is awesome to see because you were correct. Only 12% of you had the outlook of it going lower during the speech, and you can clearly see it went much higher. But 21% of you said that you're too sophisticated to vote. Very interesting. Well, we're going to go ahead and end that poll now. You guys can see the results at the bottom of that. Do keep in mind, if you guys like my charting platform here, we have an affiliate link, Dan Bob Dan, the greatest moderator alive. We'll go ahead and post that in the comments. If you guys have watched all the way through, if you've been here from the start, I really appreciate you guys. We still got 20 of you here. I think we peaked at 40, so that is absolutely awesome. Let's go ahead and take a look at my screen really quick here. Make sure you hit this live button. Of course, you don't necessarily need to do that now if you are behind and you're listening to the speech. But if I hit this refresh button, let's see what kind of likes we got up to. Look at this, guys, 16 likes. Smash that like button. We can see we've already earned a couple more subscribers while we're in here. If I bring in you any value of entertainment, or if you've learned anything on this channel, please hit that subscribe button. I appreciate you guys being here. Now, we have quite a few things that I want to go over. Dan Bob pointed out something very interesting in the chat that I missed because I was there typing. Let me find out what he said. So he just said, Dan Bob says, so he just said we can sustain our current national debt, but not if it stays on its path. And one thing I wanted to touch on there, the reason why the national debt is going up so high so fast is because of the Fed rate stays. Because we are stuck at 5.5%, the reason why the national debt's going so much higher is because it's so much harder for us to borrow money from the banks. Okay, so as long as we stay at 5.5, we are paying a higher interest rate for the money, and so is our government, so is our states, and that's why the national debt continues to rise higher. So if and when there is cuts, which it seems as if, though, if we look at the CME Fed tool, we can see here in July, we are still at a 91% chance of a Fed stay, meaning we are going to be staying in July at 5.5%. It's September that we have a nice rating of 63.2%. We are going to come down a quarter of a basis point, meaning that will help our national debt come down, obviously, and it'll help spending, and it'll help rise and continue this bull market. Now in November, as you can see, we actually have a 25% chance that we will be down a half a rate point, and we also are at 45.2% by December. So it almost looks as though the market is pricing in, or not so much pricing in, but the CME Fed tool is calculating that we will see 2 Fed rate cuts. And if you guys were with me not too long ago, we talked about possibly getting 2 Fed rate cuts. I brought this up about a month ago in one of my YouTube shorts about how it just seems the way things are going with all the ease on the CPI and the PPI and the fact that we are showing economic contraction in our unemployment. It just showed that we are we're quite reaching that point where we might be able to get those 2 Fed rate cuts. Okay, so things are looking good in the overall market. They are looking very good in the S&P 500. As you guys can see, we are still holding above that 10-day moving average. Now, I will be very honest here. I am at a point where I need it to rip the Band-Aid off. One way or another, let's see that pain or let's see that gain, baby. Okay, that's what I want to see. This sideways action is killing me. I'm a trader. I'm a momentum trader. The momentum just isn't there unless this S&P 500 starts to rip tater chip or starts to break down so we can see a bounce. Now, that doesn't seem to be happening with old Uncle Tesla over here, guys. Look at Uncle Tesla breaking now above this daily downtrend. Now, this might be an area because of a daily downtrend and volume. This might be the area where I would like to get into it, but I promise you this, guys. I have tried multiple times to try to get into Uncle Tesla, and I have been hurt multiple times. So seeing Uncle Tesla rip up here and hang and loom at these 230s when I tried to get a bid at 175, and I also tried to get a bid and hold at 186. I just couldn't hold on to it, and that, you know, that's part of trading, guys. That's part of trading. Sometimes you don't always get what you want. Okay, it reminds me of a song, right? You don't always. All right, I'm not going to make everybody leave with my singing here, but listen, guys, I tell you what, this Fed Chair Powell speech is just the same song. It's the same song. He did seem very dovish, you know, but when it comes to, you know, because she kept on asking the same stupid questions. She wants him to comment on a bunch of different things when it comes to, you know, politics. And he constantly says, hey, look, we don't care about politics. We don't want it to be part of our monetary policy. We aren't going to comment on politics. Okay, yeah, but this. Okay, yeah, but that. Like, listen, honey, sweetheart, you're beautiful. You're beautiful. Thank you so much for asking these questions, but I politely decline. It was a good one. I actually really enjoyed watching this. I liked hearing from the other two Fed speakers to see what's going on in the other areas in Brazil and in the other areas, because it's nice to see everybody's been affected by this, right? Everybody's been affected by this. And Danny actually posted in our Discord, Tesla will offer more opportunities if it goes, don't worry. No, you're absolutely right. I actually brought this up just the other day too, because if this thing pushes and it continues higher and it wants to be a leader and sustain momentum, then it's going to show more areas that we can get in. So Uncle Tesla, yes, my fear of missing out. I want to be in. I want to be in. I wish I was still in this thing with 300 shares down at 179. I would be a much richer man, and I would love to be a part of this, but I currently am not. I won't have that fear of missing out, because I promise you, if I buy up here at 230, this is where it's going to come down, as it should, because right now, war cry. As of right now, we are at a downtrend. So I am expecting this to pull back. I'm expecting this to show us a little pullback here because of the resistance. Now my alert for Ollie just went off. OLLI, Ollie's Bargain Outlet. I don't know if you guys have these where you're at, but it's a retail, and you can see we're at an area where if it can get above this on volume, we might see this thing start to break out. This is a base breakout. Now it is much slower at 3.3%. I like to see things above 4%, but you can see we're starting to get some volume in here for Ollie. This might be a nice take. Risking 98.31, we could take, you know, just a couple of hundred shares here at that breakout. We can see it really starting to move here, and the spread is it's a little spready with 30-cent spread. So I don't care for that. I'd like to see that tighten up, but OLLI is definitely one to watch here. Man, I wish it had a bigger or a tighter spread here. and I wish it moved a little faster. Now, I did take a few trades during that during the speech, and while the market was trading. CORZ was one of them, so we can go back and take a look at CORZ. I just want to reset my alert here on Ollie, because if we can see this tighten up, there's a lot of, the volatility's coming in here. I just wish it would tighten up for me. And we'll go over the trades that I took while the speech was going on. I took a couple of trades. One, CLEU, I ended up stopping out on for a very small loss, about 0.5% of the account. I tried to play a base breakout on that. It did not work out, but the risk reward was there. I liked it. I also played CORZ, and one of you guys called that out. I think it was Awesome Art actually called that out in the chat, which is pretty cool. Let's turn on some music for us, guys. So yeah, I appreciate that. Let's see, the curse of loving the ugly truck. Yeah. Dan posted the TraderView app, so if you guys want to be a part of this, we also have videos in the YouTube, so you can see exactly how we set this up, so you can have all your moving averages on here, the RS ratings, the average daily ratings, all that stuff is all right there. So you're more than welcome to use that. It gives you $15 off if you sign up for the Essential plan. You guys don't have to. It's absolutely free. Everything we offer is free, but if you want to be a part of that, you're more than welcome. Walter says, thanks for the stream and chat. Gotta go. Hey, brother, appreciate you being here, Walter. I appreciate you elaborating a little bit on your thought process there. A lot of people, what'll happen is they'll come in, they'll start bitching, and then they don't give the reasons why. But you came in, you told me exactly what you thought the issues were. You articulated your thoughts on exactly why. And Walter, I hope we earned your subscription, and we hope to see you very, very soon. Yes, we are your friends in the USA, baby, and we hope to see you again, Walter. Go ahead and join that Discord so we can continue our conversations. So Ollie, looks like we are at 44. We're still very spready here. I don't really care for the spread there, so we can just go ahead. So Kava had a big pullback on today, but of course I'm using previous low of day. There goes Ollie again, man. Ollie doesn't want me to take my eyes off of it. We have some volume coming in for Ollie. And if we bring this up on the trader view, let's go ahead and look at this here. So its average volume is 1.9 million. The volume today is only at 174,000, so it's still low volume. But what I'm seeing is just within the past, 5 minutes here, we're starting to see a lot more volume start to come in. And if we zoom in on the 1 minute just to take a look at this volume bar, you can see it's a little higher than usual, but nothing too crazy. So, I don't know. I just want to reset my alert one more time here, and then we'll step away. We'll step away. It's right at that $100 area too, guys. If you look, it's last time it came up to this area, it hit $100.44 and then sold off. So it's very interesting area here for Ollie. So I do like that, okay? So anyway, back to my trades. Kava, you can see here, Kava, let's see, trade-wise says, can you do RS rating for Thinkorswim? I tried and couldn't find it. Just yes or no. I will look if it is possible. Do you use the trader? Yeah, I use TraderView for almost everything. I just used Thinkorswim basically because it's my broker. This is where I keep all my money at, and this is where I buy and sell. I do a lot of my trading platform on Thinkorswim as well, but basically when I'm looking for plays, I use TraderView. And TraderView is free trade-wise. You can use that link just above you. It's like 4 comments above. You can use that for absolutely free, and then you can watch the video on how we add the RS and all of our trading software. But I don't have the RS rating in Thinkorswim. I've never even tried to look it up or anything like that. So if you find that out, you can let me know. But no, my answer to that trade-wise is no. I don't on Thinkorswim. I just use TraderView for all my in-depth indicators. Next up was CORZ. We're up about $100 on this trade. I took the break of the trend break right here, guys. You can see it's very clear. Big push up on volume, a pullback on lighter volume. It held the 10-day moving average and then busted up a little higher than this. We decided to take that trade, and now we're just holding. I'm using the low of the day, risking close to $200, but we're going to see what happens. You know, we're up about half an hour on this trade. We're going to just let this thing ride and see what happens. My main focus today was this S&P 500, to be quite honest. And it's nice to see that we're trying to hold above this 10-day moving average. But we just, man, I'm telling you, you need to rip this Band-Aid off. I want to know where this market's going, right? Where the hell is this market going? I'd love to see it rip tater chip to the north side, of course, but you never know what's going to happen in the overall market. And anybody that tells you that they do know, that's your guru right there. You can go ahead and follow them. They'll lead you to the path of penny stocks and empty pockets. So keep that in mind. Ollie is dragging me back. It says, baby, come back. We are starting to get more volume on this. Is it tightening up? It is a little bit. So instead of a 30-cent spread now, we got more of an 18-cent spread, and now we're getting some volume coming in here. You know, let's see, at 3.3%, if we use the low of the day, where would this be at? It's only half. It's only half the ADR percentage. So I like it. I like it. A little extended from the 10-day moving average now, but if it can break that $100 area, I think maybe we can take a bid on this. So let's use $1.50 as risk. Let's think here, guys. Let's think here. We'll see if it gets me in. All right. Got me in a piece. Got me in a piece here. But we're just going to grab onto this, set our stop to the low of the day. It only got me in 60 shares. Come on back down now. There we go. All right, I'm in Ollie at 300 shares now, risking the low of the day, 98.42. I'll just show you the calculation, make sure I did this right in my head. This is how we do it. We got the average price of 99.6, so 99.96. We're going to subtract that from the low of the day, which is 98.31. And then it gives us our average of $1.65, and we multiply that by the 300 shares I just took. That means I'm risking $495. That's much, much more than I'm willing to risk. I'm willing to risk about half of that, so what I'll do is I will just sell right now half of those shares, and it made a little bit of money, but now I'm risking, let me just bring this up so we know exactly how much. Let's see, 996, well, I gotta do the math again. 99.96 minus the low of the day. We'll actually use this low, 98.32, 98.32, and that gives you $1.64. And then you multiply that by how many shares that you want or that you own. So that's $246 risk. That is what I'm willing to take. So that is a little under 1% of my account. So I'm risking $250 on this trade, much better than the $400 that I originally had. Now this is a slower mover at 3.3%. I try to look for those trades that are 4% or higher, but I like the retail trade right now, you know, like your Amazons, your Abercrombie and Fitch, your those sectors have been doing really, really well. So I'm gonna go ahead and take that bid. We're gonna see what's gonna happen here. I am still risk on with the S&P 500 holding above a 21-day moving average. And of course, if we can get some legs here holding this 10-day moving average, I would be just fine with that too. I think the speech went over well. I think the overall economic data has been coming out pretty well. And if we look at, let's see here, let me look at the economic calendar and see what we have coming up. Now, I don't base my trades off the economic calendar, but I like to know what is happening. So today was the Fed Chair Powell speech, and then at 10 o'clock we had job openings come out. Let's see what's coming out for this week. So we had PMI yesterday, which came out a little iffy, but we have non-farm payroll that comes out tomorrow at 8:15. Initial jobless claims at 8:30, so that's going to be a very volatile time to keep an eye on the market. We have the FOMC meeting minutes, which shouldn't be too volatile because they said the same old him-haw, but it could. And then Friday, which usually we don't have a lot that comes out Friday, but we do have non-farm payroll and unemployment data. And then the Fed monetary policy report, which is just something that they have to give to say what they're expecting what they expect and what they're going to do in the future. Alrighty, Let's see, Danny. Oh, Danny, my boy. He said he also took Ollie, even though it's not a fresh trend. His entry was at 100. Well, cool, Danny. You know, it always makes me feel better when you actually take these trades. It shows me that I'm on the right path, obviously. I mean, you do trade a little bit different than we do, but the base and trend breakouts can still hold true. What is your risk on that, Danny? That's my question for you. I'm risking the low of previous day. I know you like to try to get those very, very tight risks. So are you risking, are you playing like, you know, your wish, your 5 dream or whatever? I know you have a few different, ways of trading, but how are you taking this? What is your risk, and what means did you take this? So it's obviously a base breakout. And we want to see it break out and stay above that $100 area. Right now it's trading at $99.96. We'll see if this happens. If not, it'll break down, and you know, I'll lose a little less than 1% of my account. Kava came all the way back down here, bounced off of its breaking out area or its trend break area, and is heading higher right now. Overall, I'm down $54 on the trade. We're almost back up to that break-even area, but this is a swing trade, guys. This is how it works. Okay, Danny, you're using the same as me, low of day, so that's good. CORZ, we're also in CORZ. We're up about $100 in that. It looks like it's actually holding up above this area, this trend break area, which is very nice to see. You always want to see your trades holding up above a key area of resistance, because then that will show that it is support. All right. Do you guys have any questions for me? If you do, throw it up in the chat. And while we still have a few of you watching, take a look at my screen. Make sure you smash this like button. It is right here, right now, and you can do it for absolutely free. It will cost you $0 and 0 cents. Just smash that like button, and of course, hit that subscribe button if you haven't already. We had an awesome speech today. We had a very good thumbnail, if I do say so myself. I think we're going to be doing this a lot more, guys. I think we're going to start doing morning live shows a lot more. Today we had a good amount. We had a little over 42 people at one point in time today. So that is showing me that lots of love getting thrown this way, and definitely lots of love sending right back your way, guys. So thank you so much for being a part of this. And I hope to see you guys very, very soon. Of course, you can use our TradingView link in the chat or in the description down below. Use that TradingView affiliate link, so that way if you decide to use the Essential plan, you'll get $15 off for your first month for free after your free trial. But you don't even have to buy. Everything's free. Everything we offer is free. So I hope you guys, oh, Jolene took EBS. Congrats, Jolene. We'll take a look at that in just a minute after I end this chat. But hey, thank you guys so much for being here. You guys are absolutely awesome. And we'll see you guys very, very soon. Peace. B. Stewie, thank you. Appreciate you being here. Jolene, thank you for being here. Danny, thank you for being here, brother. I appreciate you. TradeWise, if you're still here, thank you so much. Bob Dan, the greatest moderator alive, sending you some love right back, brother. Thank you so much for everything that you do. Kobe, thank you. Of course, you're a huge part of this, and I appreciate you doing everything that you can in the background for me. And anybody else that I missed, Bonnie, if you're still here, thank you so much for joining us. And anybody else that's in here that is not active in the chat, you're more than welcome to join our Discord. It's absolutely free. Everything that we offer is free, baby, and we love it. So thank you guys so much. Really appreciate your time, and I hope you guys have an awesome trading day. Cavo Poblan. Take care, brother. Peace, guys.